Let me ask you something right off the bat. When you pull up a mutual fund, what's literally the very first thing that catches your eye? If you're like most of us, it's the returns, right? We absolutely love seeing those big positive percentages, those bright, smiling green numbers at the end of the year. But I want you to look past those returns for just a second and consider the human element that's actually driving those numbers. Because honestly, behind almost every single mutual fund, there is a whole hidden world of complex, high-stakes decision-making going on every single day. Which brings us to a massive, absolutely crucial question. When you invest in a mutual fund, who is actually handling your money? Who is making the call on exactly which stocks to buy, which bonds to dump, when to dial back the risk, and when to jump on a brand new opportunity? A lot of people kind of think mutual fund investing is just fully automatic, like you put your money into a machine and it just magically grows. But the reality is quite different. Okay, let's dive into this. Section 1, meet your fund manager, the pilot of your portfolio. So in most active mutual funds, there is a real person, or sometimes an entire dedicated team of experts, managing all that pooled capital. And this quote right here brilliantly illustrates the dynamic at play. Investing in a mutual fund is a lot like traveling in an airplane. As a passenger, you might not know every single technical detail about how a jet engine works, or how the wing flaps operate, but you absolutely care who the pilot is. A good pilot can't magically prevent turbulence from happening, right? The weather is the weather, just like the market is the market. But a highly skilled pilot is absolutely essential for navigating through those storms safely and smoothly. The exact same logic applies to your fund managers. Section 2, the manager's daily tasks, navigating the markets. So what does this pilot actually do on a day-to-day basis? Because let me tell you, financial markets never really sleep. Let's break down their core actions. First up is research. Fund managers don't just throw darts and guess. They deeply study company profits, debt levels, future growth potential, and broad industry trends. Second is the actual execution, buying and selling. Based on all that rigorous research, they decide the exact entry points for a stock, which positions to reduce, and which company no longer looks attractive enough to keep around. Third, and this is crucial, is risk management. When market fear kicks in and prices drop, the manager's job is to reduce unnecessary risk and maintain strict portfolio discipline so panic doesn't destroy your value. And finally, asset allocation. They are dynamically adjusting the mix between equity and debt. If the market feels super overheated, they might pull back on equity slightly. If it's looking cheap, they'll jump on those opportunities. Section 3, active versus index funds. When does the manager matter? Now, you might be wondering, does a manager's role carry the same weight across every single mutual fund? Well, the crucial point is understanding this divide. With active funds, which you see on the left, the manager matters a lot. They are actively choosing the investments, relying heavily on all that stock-picking skill and risk management we just talked about to try and outperform the broader market. But on the right side, we have index funds. Here, the manager's role is much, much smaller. They aren't picking stocks at all. The fund simply tracks a predetermined list, like the Nifty 50. So if you're opting for an active fund, your manager's skill is literally the core engine of your success. Section 4, strategies for every investor, customizing your approach. Now, what's really interesting about this slide is how your focus needs to shift depending on your exact strategy. If you're a beginner, the rule is simple. Do not invest blindly just because a fund had the absolute highest return last year. You need to look at experience and consistency. For SIP investors, those of you making regular systematic investments, the key is not overreacting to short-term bumps. Monitor consistency over a solid 3 to 5 year period, and keep an eye on manager changes, because a new manager could shift a fund from conservative to aggressive overnight. If you're a lump sum investor, strict due diligence matters even more because a large chunk of capital is being deployed immediately. You must check their long-term track record. And finally, for the advanced SIP plus lump sum combo investors, you need funds where the manager has proven extreme discipline during heavy market volatility. Section 5, the pre-flight checklist, vetting your manager. I want to empower you with a really simple, practical checklist you can use to evaluate any fund manager before trusting them with your capital. Here are the 4 specific checks. Number 1, experience. Have they actually navigated different market cycles, or have they only been managing money during a recent easy bull run? Number 2, consistency. Do not just fall for a single lucky year. Can they actually sustain their returns over a 3 and 5 year period? Number 3, risk management. Look back at how the fund behaved during major market crashes. Did they protect capital, or did they take massive hits? And number 4, investment style. Is this manager naturally aggressive or conservative? Do they focus on value or high growth? You have to ensure their style actually matches your own personal risk appetite.
So what does this all mean? I want to leave you with this to chew on. Are you just choosing a fund off some random list, or are you actively deciding who steers your ship? Remember, a mutual fund is not just a lifeless product. Intelligent investing isn't just about picking the right category. It's about the person making those decisions behind the scenes. It's about knowing exactly who is steering your ship through the unpredictable waters of the financial markets. Take the time to vet your pilot.
This conversation is for educational purposes only. Mutual fund investments are subject to market risks. Past performance does not guarantee future returns. Please consult a qualified financial professional before investing.